Saturday, December 10th, 2016, Monaco 64, home of alternative economics and contrarian views. So I want to talk about the bond market and whether the era of easy money is coming to an end. And why do I say that? Well, because bond yields since July this year have been rising, especially in the US. And prior to that, there was a lot of talk, about bond yields going negative, and still billions of bonds are still have nominal negative rates in Europe. In the US, we never got negative interest rates. The low in the 10-year was around 135 in the beginning of July. That's the all-time low in Treasury yields. And at the time, there's all the talk, we're going to go negative in the US as well. And that reminds me of, doesn't remind me, but there's an old saying from the 70s. I think it was a saying from Leon Cooperman, who was like, a finance man. And he coined the term certificate of confiscation. And I quote here from an article in the New York Times when he was interviewed a few years ago. He says the term certificate of confiscation was coined in the late 1970s when inflation was rising. And Leon Cooperman said the following: if you look at the coupon payment adjusted for inflation and taxes, you had a negative real return. Said Leon Cooperman, who may have been the first to use the term. Mr. Cooperman now runs Omega Advisors, a hedge fund manager, but then was a strategist for Goldman Sachs. And it says here in the article, which is interesting, by the time the concept became popular around 1980, Treasury bonds had nominal yields of more than 10% and were despised. So that was, I think the high in yields was early 1981 when we got up to almost 16% in the 10-year. And no one wanted to buy treasuries at that time. They were despised. But that was the best time to buy it longer term, because that was the top in yields and the bottom in prices. So all I'm trying to say, this summer, 2016, all the talk was about negative interest rates, how 13, I think it was 13 trillion worth of bonds have negative interest rates, and how that was going to increase, and like how bond prices are going to keep rising. Because as you probably know, or may not know, when bond yields drop, the prices, rise. So if you buy a bond that yields 1%, a 10-year bond that yields 1%, let's say, and the yield drops to zero in 6 months, the price of that bond is going to go up quite a bit because you still have 10 years. So the capital gains will be pretty good. And that was all the talk. And I've made a lot of videos about the bond market because it's the market I worked in for over 20 years. When I started out in Switzerland, and also here in London. The core market that I covered was government bonds, interest rates. So I think that, all the talk about the negative yields and the high bond prices this summer is reminiscent of the talk in 1980, 1981. So it might be the best time to sell bonds right here because interest rates might be, bottoming. So let's have a look here at what we did this week. The 10-year U.S. 10-year yield closed at a more than a year high at 2.4675, so 2.4675, so basically 2.47%, and it was up 8.5 basis points on the previous week. The 30-year bond yield closed at 3.1529, and it was up 9 basis points on the year. But the 10-year yield is the more is the benchmark. It's what all the investments, paper assets, financial assets, all asset classes are priced off that, because U.S. Treasuries are considered risk-free rate of return, because the U.S. government is never expected to default. So it's the risk-free rate of return, which is used to price all assets. So let's have a look here. So let's have a look at the 10-year yield for the last year. I'll bring up the chart, and you can see in July, beginning of July, we just dropped below 140. So that was all-time low, around 135. And now, as you can see, it's been pretty much a one-way up for yields. It accelerated just before around the time of the election, November 8th. You can see that we've gone from 180 now to almost 2.5. So that's the 10-year yield short term. And I'll quickly look at the 30-year yield. Has done similar thing. We got down to 210. And now we're at 315. That's the 30-year yield. So the other thing I wanted to talk about, and I'll come back to the bond market a little later on, is Jim Rickards' new book, The Road to Ruin. I got that in the post yesterday. I've started reading it, and it's interesting. And I think it's in the introduction, he talks about this risk-free rate of return. And I quote from page 8, he says, "The extended balance sheet of too big to fail banks today is approximately $1 quadrillion, or $1,000 trillion, poised on a thin sliver of capital." So that's including all the that's including all the derivatives, which are usually not on the balance sheet. And he goes on to say, how is the risk embedded in this leverage being managed? And he says the prevailing theory is called value at risk, or VAR, V-A-R. This theory assumes that risk is long and long and short positions is netted. The degree of distribution of price movements is normal. Extreme events are exceedingly rare, and derivatives can be properly priced using a risk-free rate. So that means the 10-year yield, the risk-free rate. And it goes on to say, in fact, when AIG was on the brink of default in 2008, no counterparty cared about its net position. AIG was about to default on the gross position to each counterparty. Data showed that the time series of price moves is distributed along a power curve, not a normal curve. Extreme events are not rare at all. They happen every 7 years or so. And he goes on to say, and the United States issue of benchmark risk-free bonds recently suffered a credit downgrade that implied at least a small risk of default. In brief, all four of the assumptions behind VAR are false. I think the downgrade was sometime in 2011 when gold made an all-time high around 1900. So that's Jim Rickards talking about the risk-free rate of return. And I want to show you now, first, like a 5-year chart of the 10-year yield, just to show you where we are technically, because I like looking at the fundamentals as well. You know, I know that the Chinese and a lot of foreigners have been selling treasuries, and that's interesting to know, but I think the charts also tell a story, and it just makes it easier for people to clearly see what's happening. So I've got this 5-year chart here of the 10-year. You can see that in 2013, roughly there, 2012, I think it was, we got a low below 1.5, and then we went up to 3% by the end of 2013, beginning of 2014, 10-year yield. Then we've been dropping ever since. We made a low this summer at 135, and it's slightly below the previous low around in 2012 or 13. I'm not too sure which year that was, but it doesn't really matter. It's just the analysis here. You can see that we formed basically, it's not a perfect double bottom, but it looks like a double bottom here, you know, at 1.5 for all intents and purposes. And now we're going up here, and the 2.5% level you can see there from 2015, that was the high in 2015. Once we break that, and I think we will, we might see a little bit move up and down, you know, but I think we will eventually break that. Then the 3% level will be like the midpoint in this double bottom, and the move would imply a move towards, you know, 4.5% at least in the 10-year yield. When that will happen, I can't say, but that's what you take the double bottom and you measure just below 1.5. You measure it to the midpoint. You know, that's another 1.5 or a little more, 1.6, and you add that to the 3%, and you get 4.5 to 4 5/8. I would say. So very important levels to keep an eye on treasuries here. 2.5, the 10-year yield, 2.5%, and I think once we break 2.5, I think we could really see a fast move up to 3%. And now, you know, this was more like medium term. Now the longer term picture, and as to why I think the era of easy money, the era of financialization, the era of asset bubbles, the era of bubbles in general, the finance and Wall Street might be over, is this longer term chart. As you can see here, from after the war until 1981, I guess, the City of London and Wall Street were around, but it wasn't where you wanted to go to work, and you can see why. There wasn't any easy money. Rates went from around 2% after the war all the way up to almost 16% in 1981. So and since then, though, it's been going one way, and as you can see here, from 1981, we've always had lower lows and lower highs in the cycle of the ongoing bull market in bonds, or ongoing drop in yields. And you can see that the last low we made here, compared to the one from 2013, it went slightly lower, but it looks like a double bottom. So it doesn't look like we just barely made a lower low. But if we break 3%, that pattern will be broken, because we will have broken the previous high. And and we will break the trend line that comes through from the mid 80s in the 10-year yield. And so that's, signaling to me that we could be, at the end of an era of easy money, easy profits, big bonuses on Wall Street, and also on Main Street. People aren't going to get the easy loans they used to get, all the credit card spending. There's going to be retrenchment. The U.S. government as well. The effect that this has had this last 35 years of these dropping interest rates, and I think a lot of it has been manipulated through the derivatives bubble, because derivatives help the financial institutions, central banks, control interest rates. They always want interest rates to go lower, and the derivatives help that. Prior to the 1980s, derivatives were something only traded on agricultural commodities, sometimes currencies in the 70s. That's when it started. But derivatives didn't exist for bonds or anything like that. It was only in 1980 that it started. So, and I think in 1999 with the abolition of Glass-Steagall, and allowing a U.S. commercial bank to get into the derivatives game, that's exacerbated that even more. But the the outcome of all this easy money and decreasing interest rates has been a huge creation of debt, a mountain of debt, and it's just common sense. If someone, an average individual, starts borrowing too much and then loses his job or her job and gets into trouble, is that person going to be offered more and more loans? I mean, that's the same thing with the whole financial system and the U.S. government, and this applies to all the other Western countries. I'm covering the U.S. because it will impact the whole, the rest of the world. So, the U.S. had just under $1 trillion national debt when Reagan came into power in 1981, and now we've got 20 trillion. That wouldn't have happened if interest rates hadn't been going down like it is. So it's time to pay back. It's time to pay back not only for the U.S. government, but the whole system and everyone that has a lot of debt. In the last 35 years or so, it's been a relatively smooth ride because interest rates have always been going down and people have been able to refinance the debt and pay less on their mortgages or on the government debt or whatever it might be, corporate debt. So the other thing I want to say, we need to keep our eyes on the ball, and the ball is the 10-year interest rate. It's not the Dow. I know the Dow is approaching 20,000, but I made a few videos. I think one was in September, the other in October. At that time, actually, we were seeing the stock market go down and the bond market go down, which is very unusual. And now, the bond market is continuing to go down, but the stock market is going up. But we didn't, stock markets from 1940 to, I guess, 1980 didn't do badly, but didn't do as well, as we've done since 1981. The Dow was at 800. Now it's 20,000. So, yeah. I think, very important then to keep an eye on treasuries and interest rates, the derivatives bubble as well. Derivatives are priced off interest rates, and the majority of derivatives now are interest rate derivatives. I mean, prior to the 1980s, derivatives were traded on commodities. If a farmer wanted to protect the price of his crop, he would, sell some wheat futures to, lock in the price. That was, those kinds of derivatives I think are fine. But financial derivatives, they're just very dangerous in my opinion. So, yeah, that's it for now. So, yeah, don't let it's like a head fake in a football game, or American football or European football. You look one way and you pass the ball the other way. It's what I think that's what the Dow's doing right now. People are all focusing on the Dow, and yields are going starting to go up, and I think it's much more important for the financial markets to keep an eye on yields. And yeah, so if you enjoyed this video, please give me a thumbs up, share it far and wide, and subscribe to my channel if you haven't yet. If you'd like to donate to my channel, there's some links below in the description, and I'll talk to you later. Bye.